if you make a cash purchase, you've got to have the cash accumulated, right? Somewhere. I had the cash. I could have paid $30,000 for the truck, but I didn't. I bank wire transferred that money into an existing life insurance policy. And this is what I'm going to show you. Now look, what I put together today is just an example of a loan. And we have many masterminds in my practice, groups of clients that we share ideas with and concepts. And I put it together for them just to show the timeline of a loan. You know, Nelson's talking about a loan. He's illustrating loans. And I just put this together for a timeline in the beginning. But there's so much that you can see from using a policy. I created it a couple of years ago, and then I'm just going to continue to add to it. Okay. If you have any questions, you know, I'll be more than happy to answer them. In my practice, we use about 5 different life insurance companies. At the end of the day, I don't really care who they are. If you want to practice banking, you need a good, strong mutual company, right? Properly structured life insurance policy. And then you need to go learn how to use it. And you learn how to use it by using it, right? And it's really that simple. Of course, Nelson gets it done. He created the 4 basics. Think long range. Don't be afraid to capitalize. Don't steal the peas. And don't do business with banks. It's really, really simple. Guys in my industry, you give us enough time and we'll complicate the fire out of it. It is extremely simple. Okay? Now this is a real life policy. And the reason, here, let me back up a minute. The reason I wanted to do this, why in the world would I use a life insurance policy? We can all go to the bank. We can all go to the credit card company, the third-party lender. We can go to our family members that have qualified plans. You know, they can borrow money from them. Why would I want to take the time to set up a life insurance policy, build capital in there, and then borrow from it? And I'm just trying to share or show some of what really happens in a policy when you do that. Now, there's no magic in loans, right? You can't get rich borrowing money just because you're borrowing money. It's what are you doing with that capital, right? You're the most profitable thing you have going, using your God-given abilities and talents. There's no magic in loans or debt. It's what you do with that capital. That make sense? Do you agree with that? Okay, so look, we're all busy, extremely busy. There's no question, but we're all also banking. Every one of us are banking, right? Okay, so just looking at a policy, I want to consider the timeline of a loan. The loan, what does it take to get a loan? What does it look like? How do I want to repay the loan? Do I want to pay the loan off early and be forced to go buy another policy, or do I not? You know, the banker can do anything he wants. Okay, it's who is the banker. So we're just going to look at the timeline and the effects of a policy. And I want to demonstrate, and Nelson has clearly in his book demonstrated that the actions of the owner of the policy have a greater bearing on the results than even the insurance company. I just want a strong, well-run mutual company. I don't care who they are. Now, I'd prefer them to be open to this concept, right? I mean, don't make it difficult for me to get a loan, right? I want access to my capital. So I want them, you know, at least to have a good attitude or a like mind, right? I want them to know what I'm doing, and I don't want them to work against me, okay? Some of the companies do. Now, look, we're going back in time. This is a real life policy. This is not my clicker. Me and the clicker, we're just now getting to know each other, okay? This is December 2014. And I've got this up here just to show that, yep, I'm as busy as you are. We're all busy. Right? They're working me like a Hebrew slave right up until Christmas. Right? So my heart goes out to you. I get it. Why do I want to take the time and use a policy to bank? All right. Now, I live out in the country. You know, my dogs get in the back of my truck. I drive trucks. And I drive them till the wheels fall off of them. Okay? I get 10 years out of a truck. All right, so here's just a calendar. December, y'all seen how full my schedule was, right? Friday morning, I go out to the truck and it starts making a noise, you know, and I grew up in the car business. When I was a boy, my daddy was in the car business. This was making a bad kind of noise. I'm not going to shade tree mechanic it. It ain't going to be, you know, fixed. It's going to lay down. So sure enough, you know, it's confirmed dead, my truck. I have a client. They happen to have the largest pre-owned automobile dealership in Fort Worth, Texas, right? And they understand banking. As a matter of fact, after a couple of months, you know, after they became my client, a couple of months into our relationship, he said to me, James, you know, we're in the banking business. Cars are a byproduct. And he's absolutely right. All right. Third generation car lot. So I call them and I say, look, I need a car. I need a truck. Can you help me out? They said, yeah, what are you looking for, James? A Chevrolet, a Ford, or Dodge? And I said, yes, please. All right. And he said, well, what do you want to spend? We can get you a 2015 for about $30,000. We can get you a 2014 for about $27,000. And then we could probably just get you a late model, low mileage truck for about $25,000. What do you want to do? And I said, that's exactly what I want to do. Thank you. Right? I just need a truck. Okay? So he said, okay, no problem. So now in my mind, I'm going to spend $30,000 for a truck. I don't know what he's going to find. He's going to be a Chevrolet, a Dodge, or a Ford, and I'm going to spend up to $30,000. You know what you can spend on trucks nowadays? Right. $75,000. I mean, my house didn't cost that much. Okay. So he calls me a couple of days later, and he says, James, we found a truck. You probably wouldn't be interested in it. You know, it's an older truck, but it's really low mileage, one owner, but it doesn't have leather, so it's probably not your speed. I'm like, what is it? He said, well, it's a 2010 Dodge truck, but it's one owner and it's strong, 4 doors. And I'm like, okay. He said, you want to drive it? I said, sure. So he brings it down. Okay. I don't know if I'm going to like the truck or not. He was gracious to let me drive it. Okay. So it's a strong truck. I decided I liked it. So I'm still thinking I'm going to spend $30,000 on a truck though, right? Now I can pay him. If you make a cash purchase, you've got to have the cash accumulated, right? Somewhere. I had the cash. I could have paid $30,000 for the truck, but I didn't. I bank wire transferred that money into an existing life insurance policy. And this is what I'm going to show you, okay? All right, I know these numbers are small, but I married up like all you guys in the room. Come on, y'all, that was good. I married up just like y'all, right? My wife, she's younger than me. She was 39 years old when we bought this policy, and this was purchased in 2010. This illustration was ran in 2011, and I'll prove all this, right? So in 2010, I put $10,000 into this policy. The company said I'd have about $8,300 $8,130 in cash value at the end of the year. Now, you know that when you talk about life insurance, everybody wants to stay, and there's two sides to this illustration. This is a guaranteed side. This is a non-guaranteed side because this side has the dividends. All right, everybody says, now look, that's the guarantees over here. All right, let's talk about this side. I tell them, no, this is a mutual company. They pay dividends. They've never failed to pay dividends, whoever this company is. All right, so we're going to use this side of the ledger because I'm going to include that dividend. These companies, if they know how many people are going to die next year, they got a pretty good idea of what they can pay in a dividend. Does that make sense? Okay. So, and I'm just going back to the basis, right, of the original illustration. They said I'd have $8,130 in cash value. All right, that's 2010 projecting forward. And if you look September 14th of, well, that's not the, it is a September policy anniversary, I believe. September of 2010. Y'all think about what the stock market did through 2010 and 2011. Okay, this company's projecting out from there. And I got to tell you, as soon as I hit print on this illustration, it's wrong. It's wrong as soon as I hit print. Right? As soon as I hit print, it's wrong. Because this company can't illustrate what I'm going to do, what I'm not going to do. They don't have control over the interest rates. You tell me what interest rates have done in the last 6 years. They've gone straight down. They're talking about negative interest rates in the U.S. They're already there in Europe, right? Zero. You got to pay the bank to put money in there. All right, so interest rates have come down. Oh, looky there. Sorry about that, gentlemen, ladies. 8130. All right, so if that's 2010, that's 2011, that's 2012, 13, 14. That's where we're at, December of 2014, right? Okay, we're actually right here. 10, 11, 12, 13, that's at the end of 2013. And they're projecting that I'd have $13,862 in cash value and a $352 death benefit. But $352,000. But I want you to see here, pay $10,000 the first year, and then I lowered the premium to $2,000 or $2,200. I wouldn't even write a policy like this today. Okay? And people say, well, why'd you do that? Well, I promise you the $10,000 or that $8,000 difference in year 2, 3, and 4, it went into other policies that I own. I've created a place to put money. Right? So I'm going to have a windfall in the future, so are you. All I've done is create a place to put money. Okay? All right. Oh, looky here.
Why would you create that policy again? Just because the premium's too low?
Yeah, why wouldn't I create this policy again? Why wouldn't I do this again? I would not write a policy where there's $8,000 into the PUA and $2,000 to the base. I would not do that. There's not enough money going into the base premium of this policy. What it did for me, though, it gave me a really high cash value in year 1. Right? And we did some loans and loan repayments that I'm not illustrating here, but they weren't big. Thank you for that question. That's a great question. Okay, so here is an annual report. Let's see if that's big. It is. So this is the first annual report, I believe, issued 2010. So this is the year ending 2014. All right, so I'm 4 years later. Here's really where I'm at when I purchased the truck. Now, they said I'd have $13,867 or $13,862. I've got more cash value than they projected. And they said I'd have a $352,000 death benefit. Deadly accurate. Right? Okay. Now, because I didn't put that $88,000 a year in year 2, 3, and year 4, with this particular company, I have the guaranteed contractual right, but not the obligation, to go back in time and pay those previous PUA premiums that I didn't pay.
Oh, really?
Yeah, really.
So wait a second.
Yeah.
$8,000, now you can pay that premium from the time, second year, third year, fourth year. If you had $24,000 you pay each year for that?
Yes.
I like it.
Yeah. Me too. All right. So, now I had the $30,000. I'm going to buy the truck anyway. Why don't I just write the man a check? Right? Okay, well, I have a place to put it right here. How about I... It did. It did. I put it here first and then took a loan to purchase the truck. I was going to do that anyway. Right? Okay. So I'm just saying, I'm just bringing this illustration up and this, 4 years later, an annual statement to show that there's accuracy. These companies are not playing games. They're not playing games with numbers on pages, right? These were accurate numbers. Okay. Here is the bank wire transfer. December 12th, that Friday, I bank wire transferred the money in. Cost me $15. It went right to my policy. I called the company and I said, apply it to my PUA, my paid up additions rider. Okay? They do this for me because I can't see. Make it big. Okay. I went into the bank after 12 o'clock. Banks don't transfer money after 12. Right? So the insurance company the bank didn't transfer the money actually until that Monday. Now, of course, my friend has called me and says, James, do you like that truck? I said, yes, I love the truck. Don't just quit looking. He said, great. That truck's not $30,000. I said, perfect. I'm getting ahead of myself here. I just want you to see the insurance company on the 17th. They said, thank you very much for your $30,000 premium. It went straight to your LPUA, which is a level paid up additions rider. So it goes straight to my policy, right? And so there it was. It was applied the next day. Bank wire transferred one day, applied to the policy the next day. Now, I gave them a day before I requested a loan, so my bank and the insurance company wouldn't be thinking I'm trying to launder money. I did it for them, right? And of course, right in the middle of all this, I'm thinking, James, you ought to take pictures of these things so you can put them on a PowerPoint so you can demonstrate how long it takes to put money into a policy and get money out of a policy. It took me more work to do this PowerPoint than it did to get the loan. Right? Okay. Now, when I requested that policy loan, I had to sign a one-page form, one signature, and my wife had to sign because this was her policy, and we're in Texas. It's a community property state. 2 signatures, 1 page, and I fax it or email it. Now, how easy is that? Can you do that at your bank? Now, I know you can do it with a credit card, no big deal, right? Okay. So I said, well, look, overnight me the check because I've decided to buy the truck. Okay? Here you go. Overnight me the check. I'm going to pay him $20 to overnight it. Here's what I was trying to get to. The truck was only $18,000. It wasn't $30,000. So now I get to practice Parkinson's law. I could have been driving the $30,000 truck. I'm prepared to spend $30,000 for the truck, but he shows me a great truck at $18,000. That other $12,000 is still in that policy. Okay? So I get the check overnighted to me. It goes to my home on a Saturday. So here's the check, $18,140. And on Monday, I'm depositing that check in my bank, right, on the way to pay for that truck. All right. Now, I was going to buy the truck anyway. Why did I put it into my policy? So there we are Monday. I picked it up. Now, here's a snapshot. I'm calling the company. I said, look, right in the middle of this, I decided I should make a PowerPoint. Can you send me something that shows the values of my policy before I put the money in there? And they said, sure. And so she had $364,000 in death benefit, and there was $14,289 in cash value. Now, this does show the loan, but that's the cash value before the PUA was paid and before the loan was actually credited, right? Now, I'm still ahead of the illustration, am I not? Aren't these numbers bigger than what they illustrated? And I don't care what the illustration says. At the end of the day, I don't care. I don't care. And you won't either whenever you understand what's going on in a life insurance policy that you own and you control. Okay? All right. So, what did it look like after? Well, the death benefit's now $449,000, And the cash value is $37,206. No, I'm sorry. $42,448. All right, so let's look at this. So the $30,000, out of that premium, 94% of it went to cash. You see the death benefit go up? And where did I get that number? $14,289 cash value prior to the payment, $42,448 after the payment. So $28,000 went to cash out of that $30,000 premium. So $1,841 bought a paid-up death benefit of $84,346 overnight. That's my wife, right? So now if God called her home tomorrow, who do you think would get that money? Me or my children, right? And it's a one-time payment. All right, they didn't send me all that. They did not send me a check for $1,800 because I paid the premium. Right, death benefit has a cost. There are no deals in the life insurance industry. Right, they don't give away free death benefit, but it's still a bargain. Put in 30, get an $84,000 death benefit just on the death benefit cost. So the net cash value increase now will always earn interest and dividends forever. Forever. All right. And I was going to buy the truck anyway.
How'd you structure the payback?
Let me show you. I want you to see they projected a $575 dividend, though, with that original pay schedule. I'm out here in 2015. At the end of the years when the dividends paid, I was at the beginning of the year when I purchased the truck, right? But 5 years ago, they said, well, we're going to pay a $575 dividend. Well, they paid a $690 dividend. Now, why'd they pay me a $690 dividend? Because I'm the life insurance agent and they love me, right? Because they're paying. Now, the money went straight to the cash value. It's always going to earn interest and dividends tax-free forever. An exponential curve, right? I had already created an exponential curve in 2010. That money's going to compound and increase tax-free interest and dividends forever, right? Now I'm just adding to that exponential curve, right? 5 years later. All right, look, all of y'all, all of me, all of us have one exponential curve in our life. Just one. Right? All right. Now, I made the dividend go up because I chose to put the money there. The money went to the brick and mortar bank because I don't write checks from a life insurance, third-party checks. The car dealer wasn't going to take a third-party check from the insurance company. It went to a brick and mortar bank. Right? But I could have wrote him a check because the bank wire transfer came out of the brick and mortar bank to the insurance company. Couldn't I have written him a check for $30,000 anyway? I was going to buy the truck. Why'd I put it into the policy? Because I could, and I'm the banker, and now I've affected not only this 1 year's dividend, I've affected every dividend in the future to the positive. Right? And that money is in the policy. Okay. Now here's what I did on an amortization table. My office can run amortization tables. Julie can, Jake can, Carol can, my clients can. This is just a visual calculator. It shows an $18,160 loan. Okay. The insurance company is charging me 5%. And it's only fair if they're a mutual company. When I put money into the policy, by contract, they have to put that money to work to meet future obligations. Dividends, death benefit, and cash value. Right? That's their obligation. They've got to put that capital to work. Now, if I have a guaranteed right to a loan up to my cash value, shouldn't they at least charge me what they have to earn to meet their future obligations? Right? If I put money into the policy, they've got to put it to work. They've got to go earn at least 5% to meet the future cash values and death benefits. So if I take money from them, right? Because I'm using the bank's money, my money's in the policy. Now I'm using the insurance company's money. Shouldn't they at least charge me what they would have to earn to meet the future obligations? Of course, or it wouldn't be fair. You could have a policy with the same company and you get interest-free loans. You're affecting my dividend in a negative rate because we're both co-owners of the company. Right now, look, you get interest-free loans on new cars. Did Nelson talk about that? Do y'all really believe that? Okay, you tell me how many interest-free loans you can get on a pre-owned car. They won't even advertise 0% interest on a pre-owned car. This is a 2010 Dodge. Yes.
I had a friend recently who wanted to buy a motorcycle, and I said, "Well, just finance it through your
Policy.
He's like, "Well, why should I? If I'm only going to be paying 1% or 2% with other people, why should I finance it and pay 7 or 8%, or more?" And I said, "Ask someone who knows better than me."
Well, I'll use all your capital you want to lend me at 1%. I'll take a 1% loan all day long.
Sure.
All right. Now, if I have access to my capital at 5, I'm personally okay using your money at 1. Right? Okay. All right. So if you make me a loan at 4, right? I'm borrowing his money at 4. I'm leaving my money in the policy, and I would pay 5 to get that. It's math. I win in the math. Right? Okay. But if you get mad at me, our relationship gets crossed, you show up and you want to start repossessing something or controlling the loan, I'll access my capital at 5 and tell you, thank you very much. Okay, goodbye. It's okay to use money at a cheaper rate if you want. It's who has control. Right? Control. And then however much you want to participate in the banking system. If I go to the bank, they're going to lend me money that didn't exist at 1%, make me sign a personal guarantee, and put up collateral. I just don't agree with that. I'd rather pay additional interest to an insurance company, but that's a personal choice. Yes?
Isn't he recovering his payments anyway?
Yes. I'm just saying it's okay. It's okay. The math is okay. If you want to go through the math, it's okay to use somebody else's money at a lesser rate.
It's okay to, but you might as well. If you have it, you might as well pay your policy.
Might as well, right? Because then I'm going to really benefit. And I just showed 1 year of dividend. Okay, my wife she's 39 at the time. She's 45 now, 44. Her people live into the 90s. There's 50 years that I've affected the dividend in a positive way. Yes, sir. Wait. What?
The 5%, is that going to the insurance company?
Yes. No, it's going straight to the insurance company because I'm using their money. My money is in my policy on an exponential curve. And I'm not going to do anything to interrupt, retard, restrict that exponential compounding. Okay? And I said her people, because they're farmers from Nebraska, they live into their hundreds. Okay? Thank you. They're German. I'm Irish. My people, we, would rule the world if it wasn't for alcohol. But, right? Okay, so here I'm paying the insurance company 5%. I'm making a loan repayment at 10. I created this amortization table, and all this is a visual calculator. Now, if I pay back at 10%, I'm going to pay back that loan in 43 months. This is what Nelson was saying. If you borrow money at 5 and you pay back at 10, you're going to shorten that amortization table. You should go and be an honest banker and purchase a new policy to put that money in, right? Because I would owe at least 3 more payments or 5 more payments. If I borrow at 5, $18,000 at 5%, and I put it on a 40-year or 48-month amortization table, but I want to pay it back at 10, then I'm going to pay that 48 months off in 43 months. Does that make sense?
Yeah.
Yes.
The insurance company don't they just charge you like it's not an enterprise loan?
No, the insurance company does accounting on their loans much different than we think, right? This is a 5% annual rate. All right. That's right. At the end of the year, I'm going to have an outstanding balance next year, right? At the end of, and they're just going to charge 5% on that outstanding balance. Exactly. I'm not even really paying that full 5% if I stick with an amortization table. Exactly. Yes, sir. Yeah, the honest banker would open a policy of at least $460 a month for at least 5 months. Well, look, this isn't the last thing I'm going to finance. This is my truck. My wife needs a car. My kids need this, or I want this. So I should open another policy. Yeah, if this policy couldn't hold that cash flow, that payment, I should open another policy. All right, bear with me here. All right. This policy was designed to take the money, to hold the money. If a policy can't hold that money, that additional interest, then to be honest, banker, you should start another policy that can hold that interest. Does that make sense? And look, out of 1,000 clients, there's 1,000 different ways to bank. Okay? Really probably 2,000, because you bank one way, you learn something that you didn't know before, you hear something that you didn't hear previously, and you do something different, bigger, and better. And it's okay. And then you should share it with somebody else that's practicing the infinite banking concept. Right?
Back to this example here. Let's just say round numbers. You stay with the original schedule of 48 months. Let's say your payment is $40 a month. You accelerated at 10%. Let's say it's $500 a month.
Yeah.
After the 43 months, after 500, you pay back the loan in full.
Yes.
Now you're saying take that 500 and take the remaining 5 payments and start a new policy.
That's right.
Why not? Why not just continue and put it into that one and get it? Start at $30,000.
If the policy can take or accept it, you should do that, or you can do that. You can do either one. But to practice honest banking, I should make this cash flow. I should own it for 48 months. That's what I created, a 48-month loan repayment, right? So whether it goes into this policy or another, and it should go into a policy that I own and I control.
So I guess under what circumstances would you not be able to put it into this policy? Great question. Under what circumstances would this policy not hold that additional interest? If I got so close to the MEC limit, that additional interest, that's what I'm paying on a loan, it is a premium to the company, and it could cause that policy to lose its preferential tax treatment. Modified endowment contract. Yes?
Number where it's going to be taxed.
Yeah. Yes, sir.
I was just trying to figure out the delineation. So what's the math? They tell you what that
Oh, yeah. Well, you know what the MEC is from the beginning. That's all in the design. Okay. You know from the beginning what a MEC premium is or what the MEC limit is. And these are all great questions and very good questions. I want to show you what I did here, though, because this policy could accept that premium or that payment, okay, the additional interest. So we borrowed at 5. I'm paying back at 10. I'm not going to repay that loan off. I'm not going to pay it early, but that would require a $460 a month payment. If I'm borrowing $18,000 at 10%, and I want to finance it for 48 months, it would require a $460 a month payment. Okay? And here's all we're doing. Here's the loan. Here's the interest that I'm paying the insurance company. Here's the principal that I'm paying the insurance company. And that total is $418 because they're charging me 5%. I want to pay 10, so that additional $42 goes into my policy. All right, because the policy was designed for banking, right? It was designed for the end user. So if we go, and why did I pick 10? Look, the last car payment we had was about $430. I figured with inflation it should be $460. There's no magic, and it just happened to come out to be a 10% round number, which is my minimum. See, this also, look, if the insurance company values their money at 5, doesn't this give me the opportunity to place a value on my money? I can set any interest rate that I want to. I value my capital at least 10%. Right? All right, so $42 a month is going straight to my PUA policy. Now, you know that's buying an additional $120 in death benefit. At the end of the 48 months, look, I've got the truck. I've enjoyed the truck. I paid the insurance company interest. There's no question. But I put an additional $2,000 into my wife's policy. It bought at least another $6,500 in death benefit, and it's all cash ready, available. As soon as I make that payment, you know, there's that much more is available in my policy for loans or withdrawals if I got mad and quit.
So the 2,000 excess payment, is that actually cash, actual cash value, cash available to you?
Yes. As soon as I make that payment 30 days later, there's $42 more in the cash value that I put in there that's available to me. And that's just accumulated over the 48-month time period. All right, now look, do you think, remember when I put that additional $30,000 that caused the death benefit to go up? It all went to cash, 96% of it, 94% of it went to cash. Right, now I'm going to earn interest and dividends on all that capital forever. The same thing happens here. That causes the death benefit to go up. It goes straight to cash value. It's always going to earn interest forever. And this isn't the last truck I'm going to buy. It's not the last automobile we're going to purchase or any other purchase. All right, now Nelson kind of alluded to, and look, they put this in there. I've got the truck. I love the truck, right? All right. The $30,000 that I put into that policy is never going to leave my community again. Right? I get all the goods and services that money will buy. That cash flow, that $460 a month cash flow is never again going to leave my personal economy. All right. Do you know why Nelson put the grocery business, the grocery store in his book? Think about it, right? Number one, y'all are not in the grocery business. That's good. All right. You don't have to make a bunch of money on one can of peas. It's how many cans of peas can you run through that grocery store. The same concept is here. It's the same truth. How many times can I turn over that $460 a month? How many times can I turn over that $30,000 making purchases that I was going to make anyway, buying goods and services that I own? That's the wealth, right, that this money buys. This money will not leave my personal economy for the next 50 years on this policy. Think about that. This is just one loan, 1 4-year time period. It's how many times can I turn that money over? Does that make sense? So when you get money into a policy, it's yours, you own it, you control it. It is not about interest. It's about the volume of money that is flowing through your hands. How much can you capture and keep in your personal economy? And then just continue turning it over and over and over. Does that make sense? Okay. Yes.
I can say a question later, but maybe suggestion. So, self-employed, you're going to put money inside the tax.
Mm-hmm. If you want to keep your property.
What I initially thought to do was, we'll just throw that money in the policy and then borrow it out later. But then, I guess I'm trying to figure out, then I got a huge payment, monthly payment that needs to go back in for the next 5, 4, 6 years, every single tax year. You have a better suggestion?
No, the better suggestion is your taxes. He's like, I've got a huge tax bill. I'm self-employed. Should not put it into the policy. Yes, but then you're going to have a huge payment for the next 4 or 5 years. No, you pay taxes every year, right? So you just take that, whatever that bill is, say it's $50,000. It goes into one policy, and you just isolate that $50,000 out of that one policy, right? And pay the IRS. And then make the loan repayments to your policy monthly. That money's there every year, every year, every year. And if the insurance company charges you 5 and you pay 10, you'll have the accumulated. You'll accumulate more money to pay taxes, which you need to do because you're going to be more successful and you're going to pay more taxes later. Does that make sense? You just break it down into a 1-year payment. That's exactly what it is. It's a sinking account. It's an escrow account. You're using your checking account right now to put money aside to pay the taxes.
Okay, so let's just do simple. Actually, I'm taking it out of cash and hold it. Sometimes.
It's even worse. Right?
Okay, so let's just say, for round numbers, let's just say $10,000 full that I could either A, just keep it in cash, or B, put it in the policy.
Yeah.
Then I use that out of the policy, borrow against it 5% to pay.
Uncle Sam's paid.
Pay the IRS.
Now you got a loan.
Now I have a payment of $520 something dollars. I don't even know what the math is.
Did you say 10,000?
Yes, sir.
It'd be about $840 a month.
So where did that come from?
Where'd the money come from to pay Uncle Sam to begin with?
Okay.
All right. Well, where'd the money come from to begin with? Don't pay Uncle Sam next year because you can't find the money. See what happens to your property.
Right. So, but I mean, then I have the next year. So I'm talking. Oh, okay. I'm paying it off in 1 year.
Yeah. You got to pay taxes every year anyway. It's an escrow account.
So use that money that you set aside to pay it off in a year?
Yes. Yeah. The savings, see, he's saving up money every year to pay taxes. All right. So you just do that one time. Separate the premium from your taxes. Now you're putting money that you were going to pay in taxes into the PUA portion of your policy. Right? So it's there for Uncle Sam. You pay your taxes.
You're saying the first year I actually keep it there.
Yeah, you just do it. No, you just do it 1 year. You're just doing it 1 year at a time. Instead of writing Uncle Sam a check, you write the insurance company a check. It goes into the PUA so you can get a loan and then pay Uncle Sam. Now you've got a loan repayment for that money. At the end of the year, that loan's repaid. You pay your taxes the next year. All right? You were saving the money. You were setting aside that cash flow savings in a escrow account, the sinking fund method to pay taxes. It's a savings cash flow, right? As soon as you make a loan, now it's a loan repayment. It's a loan repayment cash flow. The cash flow didn't change. The only thing that changed is where it was going to. Right? Very simple. I get it. It's very simple. Very simple. And then you get the long-term benefit. Number one, the taxes are paid. You get to keep your property. But that additional interest, if you're an honest banker, keeps your death benefit going up, your dividends going up, and it's all going to cash anyway. That's a great question. Very hard concept in the beginning. But once you do a loan or two, it's like, oh my God, why didn't I see this 20 years ago? It's because nobody gave you a book. Nobody gave you a DVD. So I'm telling you, buy books and DVDs on your way out. Not for you, for everybody that you love. Yes, sir. No. It could be, but generally not. If you're working with a good coach, no. That death benefit's tax-free, right? Loans are tax-free because the premium is being paid with after-tax dollars, and life insurance is not an investment. It's a replacement of a loss. So it's really not preferentially tax-treated. It's treated appropriately. Right? If you had a piece of property that got wiped out by a hurricane and the insurance company paid you a benefit, is that taxable? No. Why? Because it's not income. It's a replacement of a loss. That's what the death benefit is. It's a replacement of the loss. If I die, my wife loses me and she loses all my future income. It's a replacement of that loss. Tax-free. All right? Great question. Any others? Yeah, once you see something like this, you can't unsee it. Mm-hmm. Yeah, I can finance a house, and I look. Can I? This is not a tax scheme. Okay, it's not a tax scheme. But could my business own the truck and write that interest off? Yes. It is possible. I'd have to document the loan from the insurance company, document the loan from me to my company, right? Because it's an expense to the company, but it's income to me. And with the Dodd-Frank bill, they've complicated it. You know, it really should be the Dodd-Frankenstein Act. Seriously. But if I document both loans, it's really a wash, because if the insurance company is charging me 5 and I'm charging my company 10, right? It's a 10% write-off. That interest is a write-off to the company, but the difference in the two is income to me. And I don't want to pay income on that. I've already paid income on the money that I'm putting into the policy one time. You see what I'm saying? No. Yeah, it would be if I'm trying to write off this interest. If I'm going to write that 5% off and I'm charging more, then whatever that more is taxable. Now, it'd be a moot point, but a wash, and there's some benefit to it. If the insurance company is charging me 5 and I make a loan to the corporation at 5, it's a wash. It's an expense to the corporation. It would be income to me, but I get to write the 5 off. It's a wash. Yeah, maybe, but it depends on what your income level is. You can eliminate, what he's saying, you can eliminate the Medicare tax on that income, which is potentially true, depending on what your income level is, but you can also cause yourself another 3.8% in income under the Dodd-Frank bill. You know, so does it make sense? It can make sense, but it's not a tax game. You know, if all the money went in after taxes, I just want to use the money in a tax-free environment. You know, instead of playing their game to get a tax, you know. Exactly. Okay. Any other questions?